A very good afternoon, everybody. Welcome to Stalwart Series at Finacle Institute. Today, we are very excited to host Prateek Parekh, sir, equity strategist at Nuvama. Prateek, sir, has more than 15 years of industry experience and is known basically to have mastered the art of tracking sectors and cycles, and which is essentially why we requested Prateek, sir, and he was kind enough to agree for a guest session at Finacle for FinBridge and FinPlus students. Welcome, Prateek sir. And for everybody's knowledge, he's one of those rare combinations, where crazy smart people combined with finance expertise. So he is a graduate from IIT Madras, and he has that knack and has developed himself in this direction. So quite an inspiration to all of us. So, sir, over to you. Welcome to Finacle Institute, sir.
Yeah. Thanks, Shailesh, and thanks everyone for logging in. Thanks for the very generous introduction. I hope I'm able to do justice for the very grand introduction that you have given me. So thanks everyone. So is it okay, Shailesh and everyone, that I log off, I make my video off so that it just helps internet connectivity? I
Of
can
course, sir.
sometimes,
Of course. Of course.
uh,
Yeah.
yeah. Yeah, yeah. So thanks everyone for logging in. So in today's session, my broader objective and the message that I want to give across to everyone is the importance of cycles. How do we gauge cycles? B, what are the key metrics of cycles? Third aspect is, which is very underappreciated but very important, is, the importance of global developments. I'll show you some data and charts that India and global very much go together. Contrary to popular perception that India is unique, it very much goes together. And finally, some talk on flows. Because today, there's a lot of discussion that happens on flows, whether domestic MFs are buying, FIs are buying, who's important and who's not, and so on and so forth. So these are the broad range of topics that I fundamentally aim to, cover today, and finally, at the importance of valuations, because as an equity investor, I think valuations are very important. In bull market, somewhere that importance gets lost, and momentum presides over everything. But nonetheless, from a fundamental perspective, they are very important. So let's start. I think I'll start with one of the most important and my favorite topics, that India and EM are very much globally correlated. There is a very strong reason why India has moved very much with global, and within global, more specifically emerging markets by EMs. So before I explain some of these correlations, I just want to show you some of the very interesting charts that we have on this deck. So if you look at this is
Sir, we lost your voice.
Taiwan, all of them combined. As you can see, barring COVID phase, pre-COVID, they were almost going together, neck and neck, very little to differentiate between which one line and the other. Not only that, even if you look at the sectoral internals, they go together. Like metals, for example, Indian metals, world metals, and EM metals. Now, last 2 years, there has been disconnect. Answer is yes. But generally, they go together. Similarly, if you look at industrial stocks, very much aligned together of sorts per se. And similarly, if you look at mid caps, now there is a one could argue that a correlation has got broken post COVID, and this world is very different, or and B, that this could purely be a coincidence. Now I'll try to address both of them of sorts per se. First and foremost, we need to understand why India and EM go so well for so long, for so many years. And the reason why it goes well is that there are very large global spillovers to India. Global spillovers to India typically occur in the form of trade, for example, exports, like IT exports. IT exports demand up and down will depend on global growth outlook. And
So, your voice is not audible.
second is prices. Now, prices, what I mean is, for example, steel prices, or let's say Reliance's margin that it makes, which is GRMs, they all come or determined by the world demand. India, despite its large size, is still a price taker in almost 95% of commodities. In fact, even in agriculture commodities, a lot of our prices are actually set by global demand supply conditions. And this is very important from an India standpoint. And prices of not just commodities, but it's very important to know that even if we are trading with the world demand, if we are trading with cables and wires, if we are trading with the world in cables and wires, then even there, the marginal pricing will be set based on global demand and not just domestic demand per se. So I think this is one of the very important, uh, you know, uh, uh, thing to know of sorts per se, where you have to really, the global aspect is very, very critical. I think I guess my voice is breaking. Just 1 second. I'll just see if internet connection needs to be changed. Just 1 second. Hold on. Yeah. Is this better?
Yes, sir. Thank you.
Yeah. Okay. I hope it remains that way. And the third aspect is flows. Now, flows is the valuation or liquidity aspects which comes to India. So I
Sir,
think,
really sorry, but could you please
yeah,
repeat the content of this slide? Because quite a lot of content was, in the voice break
yeah,
part.
yeah.
Yeah.
Okay, yeah. Sorry for that.
No, no.
So I think, yeah. So the point I'm trying to say is that there is a reason why India and the world have moved together for last two decades plus. I mean, there is a break post-COVID, but there is a reason why it has broken. If you look at pre-COVID, the reason why India and the world have been so correlated is because the flows or the direction of movements happens through what we call as trade, prices, and flows. In India, no matter whatever commodity you're trading, like for example, steel, right? The import or export trade or component is only 2%, but almost entire prices are set by China or by global prices. India's own domestic demand supply has little to do with domestic prices because if we are trading an atom, the marginal price is set by somebody who sells abroad. Second is the trade part is like exports, for example, IT exports. Right now, IT exports are obviously a function of India's own products and offerings, but more importantly, a function of global demand. If global demand is strong, more and more companies are expanding, then Indian IT products will have their own demand per se. And if global growth is weak, it'll be in the exact reverse direction. And the third is what we call as flows, which is the liquidity that is provided when you have a foreigner coming and buying Indian equities. It is these three channels why India and emerging markets have moved so well for so long. And it's very important to understand that if we don't have a global growth and to believe that India can, sustain its momentum in isolation is going to be highly wrong and highly misleading of sorts per se. Now, just to take this down further, why I say, this thing matters, like for example, trade and prices matter for top line and nominal GDP. This is the broad breakdown of BSE 500 companies top line. BSE 500 is basically almost practically all listed companies top line. Now, as you can see over here, we have broken down this BSE 500 companies top line into five different buckets. What we call as tradables, commodities, IT services, banks, and non-tradables. Now, as you can see over here, commodities, which is basically metals, oil and gas, where prices are all set abroad, has very good, very high share. And so does IT. But also very high share is something like tradables, for example, autos, pharma, where a reasonable chunk comes from export demand. And if export demand slows down, then the overall profitability and prices starts to slow down. So if you look at it over here, together they account for two-thirds of our top line. The non-tradables which is, let's say, for example, Titan showroom, where you can't have, China selling stuff on, or China's demand determining the sales, what happens in Titan. Or cement, for example, where for some reason or the other, trade is very, very minuscule. These are the places where India sets the demand, and similarly banks, but they account for only two-thirds of the demand. The major chunk of the demand is directly or indirectly set by global players. And that's why if you look at this chart, is one of my favorite charts of the presentation. This is BSE 500 companies top line growth and India's export growth. Very highly correlated. Very few charts will have such high correlation. And that's where, those who say that India is a domestic oriented demand and, global demand doesn't matter to us, I think are highly wrong. If there is a global problem, global slowdown in demand, it has this very large impact on Indian corporate top line and Indian corporate earnings as well. Because of the factor that I mentioned, that India is generally a price taker in everything. We very rarely set prices on any of the variables. And if globally prices are on the weaker side, our demand too will be impacted per se. So I think this is the main point I wanted to establish, that if you look at it from a demand perspective, global outlook is very, very, very important for India's prospects. If global outlook is weak, then I think India does have a very big problem of sorts per se, right? And I'll get to into the disconnect part. Now, if you look at why we have got disconnected of sorts per se, is because India's earnings and EM earnings, which generally go together, in 2023, while top line did slow down, our earnings actually improved because we had a tailwind of margins. It's one of the very, very rare times in the last 2 decades where, despite slowing top line growth, margins actually improved. Top line is generally the fountainhead of everything, but this was one of the very rare times that margins improved. And because they improved, India's earnings outperformed EMs. And as a result, India got a higher share of foreign flows, and which led to India being isolated and seeing an isolated melt up. For example, these are charts I showed you, where India was the only country which saw an isolated cyclical melt up. Is because India was one of the very rare countries where earnings actually came through per se, which was not coming through in other places. So I think clearly the point to note here is that global is important, and if earnings are dependent on global growth, if global growth doesn't come through, then earnings will take a hit. The second factor to keep in mind on global front, and just to complete the discussion, is flows. Now, if you look at it, flows, people have been saying, a lot of commentators say that with so much of DI participation, we are no longer dependent on foreigners to shape our equity markets. Uh, that strong domestic flows alone can keep markets higher. I think this argument is flawed both conceptually and empirically. And I'll tell you why, and I'll just spend a lot of time explaining this, because this is, if you ask me, two most important concepts in markets. One is liquidity. And by liquidity, I mean understanding the macro liquidity environment. And second is, on the export outlook, on global demand. If you get these two aspects right, a large part of your, outlook and your views or your predictions on markets will be right. Now, why I say FII flows matter is the way monetary system is created or works. Generally, what happens is you think of FIIs as an external agent. They are an external agent, and when they come into India and bring their flows, this is an external flow of capital to India. What happens is RBI intervenes in the forex markets and creates domestic liquidity, or what we call as macro liquidity. And when FI outflows happen, what happens is it's a leakage from the overall country. Now, if I look at domestic flows on the other hand, they are a zero sum game. For example, today, let's say if you guys are going to put money into equity markets, you are going to by design compromise either on some form of consumption or going to take money out either from FD or from real estate, which is that you are taking money out of either your savings or consumption and putting into equity markets. But if FII flow come in from an India perspective, it is a fresh infusion of money. It is a fresh infusion of liquidity. And that is what is the fountainhead of macro liquidity. Because when FIIs come in, they bring in liquidity, RBI intervenes in the market and creates what we call as base money, which in turn finally multiplies itself. I mean, if you look at this chart over here, this is FII flows into equity and equity markets. They go very much together. Not only that, in fact, what is very interesting is that FII flows, yeah, mid caps actually do very well when FII flows are strong. Now, do FIs directly buy into mid caps? Answer is no. But the reason why this happens is owing to macroeconomic liquidity conditions, which is that when FII flows are strong, the overall liquidity environment improves significantly, which in turn leads to higher risk appetite and which in turn leads to mid cap doing very well. So that is where if you look at it, FII flows are very important for equity markets. In fact, DII flows on the other hand lag equity markets by at least 6 to 9 months. And that's where I feel that FII flows are special compared to DII flows because they are a fresh liquidity infusion into the economy. DII flows are a zero sum game. It's not a fresh liquidity infusion. It does not create macro liquidity. It is a micro liquidity which pushes equity markets and asset equity as an asset class up, but is not lift does not lift all boats. FII inflows on the other hand lift all boats because they are a macro liquidity engine and that is where they offer very well. And that's where it is more important from a flow standpoint that equity market rally is driven by FII flows rather than DII flows. And one of the good metric to know whether FII flows are sufficient or not is this LAF. This is the overnight liquidity adjustment facility with RBI. This is the amount that banks borrow from RBI or keep with RBI on an overnight basis. Now, as you can see over here, owing to demon over here, this liquidity increased substantially in this phase. Owing to post demon, a lot of currency came into banking system and banks had excess reserves which they parked with RBI. As a result, in 2017, you had very buoyant equity markets. And as and when the currency drain happened, this liquidity normalized. This problem got further aggravated in 2018-19, if you would recall, when Trump announced tax cuts and Fed raised rates, which in turn led to dollar strength and completely undermining domestic liquidity conditions. Similarly, after COVID, you had big liquidity injections by Fed and RBI, which led to liquidity surplus. And in 2023, when Fed raised rates again, this whole liquidity surplus vanished, but it did not go into deficit. Today, it is gone into deficit. And this liquidity condition is what is the prima facie determinant of risk appetite. So if you look at it, this is durable liquidity, and the green line is mid cap relative performance to Nifty. So this liquidity, one of the fountainhead through which it is created is through FII flows, and that is a transmission channel why global events have such large high influence on domestic markets. So amongst the various agendas that I had mentioned, this was my first agenda that I wanted to cover, of sorts per se. So before I move on, if there are any questions, I'm happy to address the same, Sailesh, or if you suggest we could take questions all together. I mean, whatever you think appropriate.
Sir, I think, guys, in case if you have any questions, you can simply share it with me on private chat. I'll try to sort few things out. Meanwhile, sir, I had a question if you will
Yeah,
please.
yeah, sure, sure.
Sir, on slide 9, if you can move.
Yeah,
Um, Sir, on slide 9, you mentioned the kind of breakdown of top line of entire BSE 500s, and
yeah,
then you compared it in the subsequent slide with the EM data points as well. So I just wanted
yes.
to check, has this breakup remained same over the years, or has there been a significant shift in the individual components, or on an average they have remained pretty much broadly same?
Yeah, that's a good question, Sailesh, because we've had new companies come in, we have internet companies come in and so on and so forth. But on an aggregate basis, I think broadly the number has moved from 60 to 70%.
Okay.
We haven't changed materially per se. I mean, for example, internet companies have come in, yes, but even the old traditional companies, like commodity companies, other manufacturing companies, their top line also has improved. So on an aggregate basis, we really haven't transformed much from a top line perspective. Maybe if you look at these indexes in China, they'll show very different outcomes from maybe what they are today and versus what they were 15, 20 years back. But in India, the swing is very mild, is the point here, Sailesh.
And sir, you mentioned a very interesting data point where you talked about the divergence in the trends, where you mentioned that Indian markets in last few years have seen tailwinds,
Yeah.
which has resulted into margin expansion, but not the top line expansion.
Yeah, yeah.
I just wanted to check any particular reason why that has happened only to India among the entire emerging
Yeah.
markets?
Yeah, that's a very good question, Professor Salesh, and I'm very glad that you brought this up. See, why it has happened to India only versus other emerging markets is, the sequencing of pain and balance sheets, which is that pre-COVID, India was doing a balance sheet cleanup.
Hmm,
Now, when you do balance sheet cleanup, it erodes profitability
hmm,
because you have to front run costs, you have to take haircuts, you have to pay up extra interest expense, so on and so forth. So as a result, our margins were very depressed pre-COVID.
okay.
I mean, I'll show you, for example, this chart over here. At that time, emerging markets, especially China, were levering up. So that is where I think the big diff. So, for example, over here, margins over here pre-COVID were very low.
Hmm,
We have
hmm,
been doing this whole balance sheet cleanup, which led to very big, fall in margins. What has happened post-COVID is three things that have helped margin. One is that the listed guys, owing to disruptions, have gained disproportionately from unorganized. So your pricing power has improved substantially. I
hmm.
mean, one very good data point that we have on that front is this one, for example. Look at the right-hand side chart. So we don't get a lot of data on the health of unorganized, and so we work with some proxies. But one very good data point is on tax collections. So if you look at the blue bar, F20 to F24, BSE 500 companies corporate tax growth grew by 18% CAGR, right? And whereas the unorganized companies grew by only 11% CAGR. But in H1, that growth has normalized. So this led to very high pricing power in a lot of sectors, in very initial stage of recovery. And this phenomena is more India specific rather than EM specific because in EMs, the unorganized are not so large. I mean, if there is a shock, it percolates to everybody, not just to the smaller segment of sorts per se. And the second big factor that helped this is the bank balance sheet cleanup,
Hmm.
which is that because of bank balance sheet cleanup, your banking sector credit cost or provisions came down, and as a result, your margins improved. And that's where, if you look at it, the margin tailwinds have been more India specific because India is one of the very few places where corporates have taken a lot of pain pre COVID, which wasn't the case in emerging markets. And emerging markets, especially led by China, have been doing a restructuring exercise post COVID, where they have been trying to clean up of sorts per se, which has led to their profits getting eroded. But in India, at least corporates have been doing the right things, and as a result, has led to better profitability outcomes per se, Shailesh,
Got it,
compared
sir.
to emerging markets.
It's a few follow-up questions on the
Yeah,
explanation which you gave, if you
sure,
don't mind.
sure.
So you mentioned that the shift from unorganized to organized benefited quite a lot of companies. Wouldn't that result into increasing revenue top line as well? But where we saw it was more on the lines of emerging markets or more or less in the same trend.
Yeah, that's again a very good question, Professor Sailesh. So yes, it does help in improving top line to some extent, but what has happened or what it does help to an extent, and despite that top line has not come through, but I think the profitability trickle down is even higher because for the same top line, you're able to operate with a much lower cost structure because you outsource it to everybody else and so on and so forth.
Correct.
So
Leverage
it
kicks
is,
in.
yeah, operating
Operating
leverage.
leverage
So
kicks in.
yeah, so it is a little sad that despite market share gains, it doesn't show up in top line, but it certainly has helped profitability a lot more because corporates have been very brutal in terms of cutting cost, in terms of improving working capital efficiencies, and so on and so forth, per se, Sailesh.
Got it, sir. Got it. Sir, can you please go back to that slide where you explained the divergence?
Yeah. Uh, the gap you're seeing basically, right?
Yeah, yeah, sir.
Earnings gap. Yeah.
Just wanted to quickly
Yeah. This one, right?
check one thing. Yes, sir.
Yeah.
Got it. Fair enough, sir. And just one last question. You also mentioned that there was a significant cleanup on the banking side as well, which resulted into much better performance post cleanup. So, but that happened to be what I think we saw in terms of the pie. I think it was what 17-18% somewhere around that.
Yeah. Yeah. Top line wise, yes, 14-15%.
In terms of bottom line, any estimate
It'll
what?
be 30, it'll be around 30-35% per se, Sailesh.
Okay, okay, got it, sir. Fair enough, sir. Thank you so much, sir. I
Yeah.
think, sir, we can move further with few other questions. While students are sent, I'll just quickly go through and in case we'll take it towards the end.
Okay, sure.
Thank you,
Sure,
sir.
Shailesh. Okay. So I think that's the first point I want to establish that India and global linkages are very high. And if global developments that are happening right now, especially tariff wars and all, India will also be hurt. And I think the way to look at it is not by focusing too much on which commodity is getting how much tariff, but rather at the aggregates, which is that if everybody puts a tariff war, the whole aggregate global pie will shrink and exports in every part of the world will slow down, including India. And that's the impact of tariff wars. Rather than looking at bilateral product based impact, I think one should look at a more macro impact of sorts. And if whole global pie slows down, India's exports will slow down, and so will these companies' top line. And if margins are not expanding, then I think even over here, there's a risk to the outlook per se. So I think that's the second point that I wanted to specifically highlight of sorts per se. Now comes, the point on valuations that I mentioned, and or rather, let's take up the more than valuations. I think how a market cycle typically works, and then we can look at it from a valuation standpoint and also where we are in the current cycle. Now, if you look at a typical market cycle, right? Now, these are the four stages of a market cycle, which is early cycle, mid cycle, late cycle, and downturn. Now, in each stage of the cycle, it is premised on different factors. Early cycle is the one where you have after recession, let's say, after COVID, where valuations are very depressed, and also from a top line and margins perspective, the base is very low. You get a stimulus and it leads to a big boom of sorts per se. That is a classic case of early cycle. This is a phase where you make very large money. I mean, the starting point in the cycle, fear is at its peak, and you've got to actually overcome that fear. Now, you can't catch the exact bottom, but nonetheless, this is one thing that you should look to, play through. The mid cycle part is the one in which rates start moving higher, central banks recalibrate their outlook, and to that extent, quality does well, but not so much per se. So this is a phase where people move towards quality, and some of cyclicals kind of take a breather. Uh, Third phase is what we call as late cycle. Late cycle is one where earnings at least see again a rebound, and interest rates are kind of paused at high levels. This is a place again where you make disproportionate money, but here, you will find a lot of fundamental analysts, including perhaps by myself and those who've been in market for a very long time, saying that we are entering a bubble zone. And to that extent, here is where irrationality is at its peak. I mean, this is a phase where fear is at its peak, but this is a phase where irrationality and greed is at its peak. And finally, the cycle rolls over or moves to the next stage is downturn. This is a phase where rates also get cut, but earnings also slow down. So, in a nutshell, the whole market cycles to determine it's a a tug of war between earnings and rates. How earnings are moving and how interest rates are moving is what determines market cycles. And you can gauge from the markets itself sometimes whether we have gone too far ahead or too far behind, depending on what valuations are. Now, if you look at it, whether on the market cycle, on the earnings part of it, now there are two important variables in earnings. One is top line and second is margins. Now people focus in general a lot more on top line. But if you ask me personally, what is more important for an earning cycle? It is not top line, it is margins. Margins is what determines a market cycle very well. It determines your pricing power, and valuations are given more to margins rather than top line. If you look at this chart, this is a chart at an aggregate level margins. Now, if you look at it, you had a big bull run in 2000s when margins went one way up. Now, obviously, after a point, they do not sustain themselves because you do run into resistance per se. But nonetheless, margins is what determines cycles. And if this is the whole 2010 to 2019 has generally been a down cycle phase where margins have been coming one way off and economic growth has been very weak, and you have 2 years of bull run and 2 years of bear markets. So it's been a very short cycle market. Post COVID is where again margins have moved higher. So margins in some sense are very important in determining cycles, but they to point to keep it A, they are mean reverting, and B, the drivers of margins are different in different cycles. Now, if you look at it, what is very unique about margins in this cycle, whether let's say 2000 cycle, is whether it is being driven by demand or whether it's being driven by supply. So if you look at this chart, again, we have smoothened the chart to make it on a rolling 5 year basis so that it captures the cycle even better. What is very different between now versus let's say 2000s bull market is the driver of margins. In 2000s, demand was driving margins. Demand was driving margins, which was resulting in capex, which was driving again demand and again margins higher. Operating leverage was the mainstream. And 2010s, again, weak demand was resulting in operating deleverage and margins coming down. But what has happened post COVID is that demand improvement is not very great. I mean, if you adjust for base effects, it's very, very mediocre. But what has been a very supernormal strong has been the margins part, where margins has seen a very big a very big improvement. Margins have seen a very sharp improvement, and this time around, unlike 2000s, margins are being led more by efficiency and pricing power being high rather than necessarily top line. I mean, just as I discussed with Shailesh, that these are traits which are very unique to emerging market or to India only versus the rest of the world. The positive and the negative is the positive is that even in a low demand environment, corporates are able to restore profitability and respect shareholders. But the negative aspect of this is that the cycles become inevitably short, that you don't have them very sustaining very well. I mean, if you ask me, one very unique characteristic of the post COVID bull market is the very short cycle of margin, which is look at this, that every year we have a new sector which is touted as a structural theme. I mean, structural is a right word, and then it gets busted in 4 6 quarters. And funny part is we forget about it completely. I mean, for example, IT was a big theme in 2020, 2021. People said digitalization is here for a decade, so on, so forth, and I don't know what not. Stocks did very well, honestly. They did well for 4 6 quarters. Then everybody forgot about it. And ironically, in 2022, when their demand was at the peak, margins fell and so did the stocks. Similarly, you had metals being very good, doing very well in 2020, 21. People said that global capex is here coming after a decade of weakness. It lasted for some time, again reverse course. Similarly, people made the same argument about banks, about capital goods, real estate. All of them have been 4 6 quarter cycles. And the reason why this has played out is because in all of them, the stocks went up on two parameters. One, starting point of valuation was low, and second, you had very high margin expansion. I mean, this is recovery is very unique, which is that in the first year of recovery, you're hitting the peak margins. I mean, for example, hotels. I mean, that's a sector that we all can connect with. Indian hotels today is having the same margin as it made in FI08. In FI08, it was accompanied by 30%, 30% top line CAGR in 5 years. Today, the top line CAGR in 5 years is 10%. So, I mean, it speaks volumes. But the problem with efficiency or supply disruption margins is it automatically invokes competition. So, for example, if it's efficiency led, like was the case in IT, we are going to work from home, they cut costs, boosted margins. What happens is when things open up, automatically it doesn't sustain. They hired a lot of people and brought down the entire margins. Same thing, for example, with QSR or Jubilant. Under work from home regime, Jubilant had big explosion in margins because a lot of people ordered food home and all those and so on and so forth. And moment they went on an expansion spree because they thought this demand is very sustainable. They brought on supply, margins went off, cooled down. Same thing with durables. That in 2020 under COVID, people thought that India is shining, demand is here to stay, so on and so forth. Big margin expansion automatically invoked a supply response. So that is where I feel that margins are the one that determine, and the cycles have become inevitably short. The reason, and this is not the way cycles work. I mean, for example, if you look at it, typically bull markets have big mega themes. So, for example, in 2000s, the big mega theme was capex. And by mega theme, I mean that that particular theme should give you positive 12-month alpha on any given time frame, which is you enter the theme in the first year, second year, third year, any point of the year, you should make alpha. 2010s, the big mega theme was consumption, which is that if you bought HUL in the first year, second year, third year, any year, you would have made alpha. 2020s, the funny part is there's no mega theme. And the reason why this very unique thing is happening is that if you look at it in 2000s, the whole decade was associated with balance sheet lever up. Demand was strong and corporates were levering up. This is a time where cyclicals do very well. 2010s, the whole decade, demand was weak and everybody was deleveraging. Your defensives do very well. This is a very unique decade where balance sheets are strong. So people can do capex as and where they find opportunities. But demand is very weak. So what happens is in demand being weak and balance sheet being strong, moment people see that a particular segment is making very high margins and very high profitability, corporates themselves bring on competition. I mean, for example, like Varun Beverages, great Pepsi equivalent. It was making very high margins, market gave it very high valuations. Reliance has opened Campa Cola. For example, like cables and wires. I mean, if you would have followed the news of late, Ultratech and a lot of people, these conglomerates do not enter these small segments. But why they are doing? Because margins are very high, valuations are very high, and automatically competition comes in. And mind you, India is not like US, where you can have pricing power. I mean, in US also, we have done this work that if you remove the Mag 7 stocks or the tech companies, margins are mean reverting. It's only in the tech companies where margins have not been reverted and have been going one way up. And the simple reason is that they actually have innovation and products where consumers come to their platform. I mean, I don't think any of us would have spent a day in our last decade without opening Google a single day. It's not like Google has propped us that you open my server. And that is where it is that there is an innovation or technology mode. In India, the modes are essentially distribution mode, or you have cost mode, or at best you have a balance sheet mode. These modes are very easily breakable. These modes are not modes like US, where you, even if you have capital and you have political power, you can't break those modes. So that is where I think the big difference is, and that's why from a cycle standpoint analysis, margins I think is very critical to know that how they are shaping up. And whenever you analyze a particular stock or sector, you should look at if that particular sector or stock is at its margins are at the cyclical peaks or not. I mean, 15-year margins, if they are on the higher side, by design, even if demand is strong, you should look to get cautious and look to sell. And second, if demand is on the lower side, you should look to buy. So I think that is one very important aspect to gauge from a cycle standpoint. Second aspect to gauge from an earning standpoint is obviously, as I said, margins. If margins are not there, then demand has to come through. And clearly today, margins are at the peakish level of sorts per se. So from a demand standpoint, I think the way to analyze demand is you look at the agents. Essentially, in an economy, there are four big agents, which is global, corporates, households, and government. Now, out of these four agents, somebody has to lever up. If everybody is deleveraging at the same time, I think it's a big problem. So, to that extent, you should always have a framework that someone should lever up. And the most important leverage generally has been coming from global. Like even this time post COVID, it was global that levered up because of the big stimulus that US gave. It was also government that levered up in the initial parts, but afterwards they withdrew very quickly. Corporates, they will lever up only if they see demand. And households, they typically lever up when their incomes are weak. Now, if you look at it, top line today has been very weak, is because, as you can see over, has been very weak because global delivered very quickly. And second, households, I mean, look at this chart. The left-hand side chart, this is the wage bill growth. That the total incomes that, corporates are paying to households. This includes employee additions, it includes wage hikes, it includes inflation, everything. BSE 500 companies' wage bill growth is at just 4-5%. It is abysmally low. And at the same time, household consumption loans are also coming down. So from a demand standpoint, households cannot be a demand engine. Government is focused on deleveraging. Globally, there are trade wars and uncertainties, and corporates are not going to lever up given the weak demand scenario. And in such a setup, essentially it means that the earnings outlook is worsening. And that's why, to go back to the cycles chart that I mentioned over here, earnings cycle at least seems to have plateaued out and is coming down. F25 earnings have already come down. Question is that where are rates headed and where current valuations are and its relevance. So I will cover those two topics in the next part of this. But before that, Sailesh, I'll just take a pause. If you have any questions, happy to take them now. So or else, we can move to the next section first.
Yes, sir. We have quite a lot of questions from students. I've noted it down. Just
Yeah,
wanted to check few things with you. So you mentioned in terms of a lot of businesses have modes, right? So in terms of
yeah,
distribution, you mentioned three kinds of modes there. Distribution cost.
yeah,
I think distribution we understand without naming the examples. Of course, we understand, certain set examples where people have actually built their businesses from scratch by creating excellent distribution network for themselves who are very much
yeah,
loyal to because the businesses have taken care of.
yeah,
Um, Costing, I think we understand there are certain strategic advantage, geographical as well as demographic advantages which some businesses may have. In terms of balance sheet, what you mentioned, so with just curiosity,
yeah,
without naming businesses, what exactly you meant through that, sir?
yeah. So by what exactly I meant is that suppose if you have a deep pockets, you can enter a segment and undercut it,
Okay.
right? Like MSME cannot sustain that undercutting for a very long time.
Mhm.
So that
Which is
is a
something which
mode.
we are seeing in few other segments as well as of
Yeah,
now,
yeah,
where giants
yeah,
are entering
yeah, yeah,
cables
yeah,
and paints and likewise.
yeah,
Okay.
yeah,
Got it, sir. And sir, you mentioned, in one of the slide, I think if you can please
yeah.
uh, go to slide number 20.
Okay. Yeah,
Sir, here you wrote on the chart in 2000, it was a demand-led margin. So
yeah.
just out of curiosity, how did you conclude that it was demand-led?
See, because demand and margins both are going up together,
Hmm.
which is that operating leverage is the driving margin.
Hmm.
Post COVID, demand is very weak, flattened out.
Hmm.
Margins are going up still,
Okay. Okay.
which tells you that efficiency is a driving force.
Got it, sir. Got it, sir. The next question which we had while explaining this, you mentioned a statement that there were quite a lot of themes which you saw coming up in
Hmm.
certain phases and times. So, how do you identify that this particular sector theme is coming up? So, we have a module called Economic Data Tracker, which we teach our students in terms of understanding these things. So, just wanted to pick your brain on what kind of data points do you track to identify which sectoral theme is being set in the market.
Yeah. See, I think hindsight is obviously easier and it's 2020 compared to this thing. But if I have to identify next big themes, the starting point has to be two variables. One is valuations of that particular theme should be low. So, for example, IT or like industrials or PSUs, for example, when they took off in 2023, they had a decade of lullness. They should be underowned and completely ignored by market. And second starting point for a big multi-bagger theme is the starting point of margins, which is tells you that the cycle is very depressed even from an earning standpoint. If you have a combination of depressed margins and depressed valuations, that is why you'll get multi-baggers. And you need obviously a trigger to move them higher, but your strike rate when you have that combo is very
Very
high.
high. Got it, sir.
Yeah,
Makes sense, sir. There are a few questions on chat. Let me
yeah,
go through those as well, sir, if you'd allow.
yeah, yeah,
Um,
please.
in terms of tariff war, it was one of the points which you had mentioned. This is a question from one of our students, Jairaj. So, in terms of tariff war, tariff, you mentioned it is one of the factors which impacts. Now that we are seeing quite a lot of,
Yeah.
tariff action in the markets thanks to Donald Trump, what kind of data points do you keep track of to ensure that the live impact of those on the particular sectoral points will help you catch the next theme in the market?
Yeah. See, I think looking at direct impact never gives you you'll never be able to catch the theme, because direct impact everybody knows and gets priced very quickly. Where you can make an edge is focusing on the second and third round impacts. Now, for example, tariff wars, I'll just give you a small example, let's say, right? Let's say Trump imposes tariff on Indian pharma companies.
Mhm.
Now, that impact will play out at least from a stock prices in 3 days and
Mhm.
3 trading days, and it'll be very quick and very swift. I mean, if you're lucky, you can still capture some of it, but you'll it's very difficult to honestly practically to capture that.
Yeah.
But the broader implication that you need to capture is that this tariff war is going to weigh on global demand. And if it's going to weigh on global demand, what are the global cyclicals that will be a casualty in the process? For example, metals. Like, global tariff war comes, people focus on which product, what tariff is happening. What people underappreciate is that the whole industrial complex itself is going to go lower, and you're more safer of betting on that one, and that theme is going to be more sustainable rather than a particular product or a particular idea being captured per se, because that will be very quickly captured by the markets or priced in very quickly. The second round and third round impacts at least take a bit more time to be priced in.
Got it, sir. Thank you so much, sir. So the next question is from student Hardik. His question is, given the current liquidity pressure in the BFSI and its impact on IT demand, how might Indian IT companies mitigate revenue risks and capitalize on long-term expansion plans of the banks?
Yeah. Yeah, see, that's a good question, and that's where I feel Indian corporates, it's been a little disappointing of sorts per se. Like Indian IT companies are unfortunately, and perhaps rightly so, they're too capital allocation focused. Now, what happens as a result is that whenever you venture into new technology or new product offering, there are near-term costs and the near-term pain or the transitions that take place. And shareholders are sometimes patient, but most likely they are not. Now, what is happening is that Indian IT companies, there they have now moving to a more model of 70-80% payout ratios. So, which means that from your own side, your efforts to invest into new technologies or new areas is limited. So they are entirely dependent on growth improvement. As and when growth improves, Indian IT companies will be capitalize some part of it. But if growth slows off, the efforts taken by them to mitigate are mainly on their cost structures rather than on new product offerings. So in the sense, if growth slows down, then they cut down on employees or remove contract workers and so on and so forth. The adjustments happen on the cost items rather than product offerings is the point you said, Hardik, per se.
Got
So
it. Got it, sir. Thank you so much, sir. Sir, there's one more question from Ali Asgar. I'm shorting the question. So basically, what he's trying to ask is, how do you identify a consolidation which might be upcoming in a particular sector?
yeah. So I think that's again a good question. See, I think to identify a consolidation that will be upcoming is, two parameters. One, you have to have a large giant coming in. So any consolidation is preempted by disruption. So whether it's telecom, whether it's airlines, or whether right now, let's say cement, the industry has to go through years, or if not sometimes decades of lullness, which leads to complete removal of interest, and a large giant comes in and shakes up the whole structure of sorts, causes disruption for 2 years, and then because that industry has seen a pain for such a long time, despite a strong bull run, it doesn't invite new interest. So, for example, telecom, now today the current incumbents, Jio and Bharti, are making very good profits. But given the experience of the past, new competition will take time to kick in. Similarly, in airlines, uh, today Indigo is doing very well, and rightly so. They have done a great job. But competition, I think it'll for them to be invoked, because of the very past experience, it'll take time. So the precursor to consolidation are, years of pain, and second is a large industry coming and disrupting it. Consolidation typically happens in capital intensive sectors a lot more because their bankruptcies are higher, and
Yeah,
one or two players going bust can lead to consolidation of
cheaper
sorts.
consolidate. Yeah,
Yeah.
got
So
it.
that's the way process is.
So one more question from my side. So you mentioned that the cycles have become shorter, right? In terms of
Yeah.
margins expanding, suddenly reaching peak in quite some time, and then businesses being over enthusiastic in terms of expansion, and then eventually realizing they have overshot their journey,
Yeah.
perhaps. Uh, is it something which is happening across the bay, or has something changed over the last few decades, which has resulted into this, or the promoters of the current business mindsets have become a little less or maybe more aggressive in that domain?
Yeah. So I think this is something that is more of a post-COVID phenomena, Shailesh. And the reason why it has happened is that post-COVID, we have had large supply disruptions. I mean, starting first with own COVID itself, where lockdowns completely scrambled supply chains. Then you had Russia-Ukraine war, which led to another big round of supply disruption. Then you had chip shortages.
Hmm.
So it is because of these supply
Which
disruptions
has
that yeah, where margins have led to very sharp spike in the first year of recovery itself. That if you're on the right side of the supply curve, you have disproportionate pricing power. And if you're caught on the wrong side, this thing. But because it is coming from supply disruptions or efficiencies, they don't last because I mean strong profitability invokes supply response on its own. And unfortunately, what is happening from a demand standpoint is that the recovery has been very uneven, which is that typically you have the early winners of the cycle, the listed companies, the rich guys. They once they make good cash flows, they go aggressive on capex, which then trickles down to everybody. That was a sequencing in 2000s. But before they could do that and for it to trickle down, you unfortunately had central banks tightening rates very aggressively. And nothing dissuades a corporate than high interest rates and low demand. And nothing excites him, have high demand and low rates. So we very quickly transitioned from high demand and low rates, which was in 2020 and 2021, where Fed said at one stage we are not even thinking of raising rates, to very quickly to low demand and very high rates. I mean, Fed did a Volcker kind of tightening. So in some sense, what has happened is that if you just sit back and look at the post-COVID journey itself, and you summarize from headlines, in March 2020, we were talking about Great Depression kind of a thing. I mean, IMF in its paper said Great Depression is even worse, a Great Lockdown, the term they use, is even worse than Great Depression. Very quickly, we got a supernormal reflation that we got post World War II. You fast forward, 4 quarters, you had a Volcker kind of a tightening that world has not seen in last 50 years. And then in India, after that, the pause, you had a 2007 kind of a bull market. So, in some sense, maybe we are fortunate or what, we have seen all the big global events of last 100 years
In a very
play
small
out
time.
in 5 years of our careers.
Very true. Thank you so much, sir. Amazing answer, sir. So there are still few questions. Let me work on the shortlisting part. Meanwhile, we can get started on the other part.
Okay, perfect.
Thank you so much, sir.
So, yeah. So basically from a market standpoint, so I've covered mainly the cycles and its importance and earnings and its importance. That earnings is clearly on an inflection point. The second point that I want to cover here is obviously rates, but before rates is valuations. And why valuations are always important, and it's important that you don't get carried away in bull market. First and foremost, if you look at on valuations, whenever we have a particular stock of a particular P, let's say 10, 15, 20, 30, 35, there is an implicit growth assumption. I mean, a stock's P by E is nothing but a DCF. And for example, over here, if you're buying a stock with a trailing P of 35, you are assuming that the next 10 years will deliver an EPS CAGR of 22%. And that is only if that you're assuming it will give you only 12% CAGR earnings growth. So by design, your asking rate or of an earnings, sustained earnings, keeps on rising as valuations become high. And that's why markets are cyclicals, are very cyclical. There's nothing structural, or very less part of it which is structural in markets of sorts per se. And if you look at it even empirically, starting point of valuations have very high predictive power for next 5 year returns. I mean, this is my favorite chart of the presentation. The x-axis is the starting point of BSE 500 on a price to book basis. Y-axis is next 5 year return CAGR. This has an R square of 70%. Very few variables in market will have such high R squares. It tells you that from a medium term perspective, if you buy something which is very expensive, it will become very painful, right? I mean, that's true for probably most things, right? For example, if you pay too much for a particular course of Pinnacle, which I hope is not the case, then to make meaningful return from a 5 year perspective out of it will be difficult. But if you pay appropriately and at the right time, you will make good returns. Same is the case with buying a car. I mean, if you pay the price of BMW for a car of Maruti, I mean, both are great companies, but nonetheless, to fully utilize that is going to be very difficult. Same with a house. You know that if you're going to pay a South Bombay or particular very high location flat in somewhere else, you're not going to make returns out of it. So I think valuations are fundamentally very important in most things, and they are very good factors for medium-term returns. Now, are they the best timing tools? The answer is no. And in fact, people say that equity markets make returns in the long run, but how long is the long run is also important. For example, we have had in the past that if you start investing at very high starting point of valuations, then you can have decades of lullness. So for example, this is Nifty index. 2007 to 2013 market was flat for 6 years. In fact, capital goods index, which has been the theme post COVID, I mean, very few people will know that the 2008 peak, 2007 peak got broke in 2021. For 13 years, index was flat. Similarly, NASDAQ index, which has been the theme of last decade and for most of our careers of sorts, 2000 ka peak was broken in 2015. Look at S&P 500. In the whole bull market of 13 years, index was flat and it had big drawdowns. So the entry point of valuations is very critical. If you buy something which is very expensive, I think the medium term returns are short going to be very weak. Now, there is a chance and a reasonably good one that the next 12-month return will be good because valuations are never a timing tool, but they are a great guiding tool for a medium term returns. So, and similarly, look at MSCI EM. Even today, it is yet to break its 2007 peak. So, to that extent, it is very important to look at focus on valuations, and that's why today in India, a large part of the market is quite expensive. And if you go by the P by B formula from valuation standpoint as well, it gives you a feeling of the late cycle characteristics per se. So even from valuation standpoint, you see a big melt up over here, then sideways over here, and a big melt up here. Today, from a valuations and margin standpoint, you get a sense that we are close to the late cycle part of it. The third aspect is interest rates. And after this, maybe we can again take the next round of questions. On rates as well, if you look at it, it is very important that you know how you look at rates. And that's where if you look at it, for example, on interest rates as well, what is very unique, again, this once in our lifetime kind of a thing, that central banks have cut rates. You know, US Fed has cut rate by 100 basis points, ECB has cut rates by 150 basis points, BOE by a similar amount, but the trickle down of that to bond yields is very low. In the sense, it's the first time in our active careers where central banks are cutting rates, but bond yields are not coming down. And the reason why this is happening is because if you look at this over here, this is the first time where sovereign debt is a problem. I mean, US government debt to GDP is at World War II high. In the sense, in the past whole 40 years, we have never had to worry about US government debt levels because they are sovereign, they are reserve currencies, they can print their way out. But what is happening is that even they seem to have a limit. And in some sense, the reason why your issue is happening is that sovereign debt issuances have been going through the roof. Even after COVID, US government debt has increased by $5 trillion in last just 2 years. This has come because their social security requirements are going up very substantially. And second is that this is one of the reason also why growth has held up. But the problem is that their rates or issues are going up at a time where central banks have not been or have been fighting inflation. And as a result, you've had a demand supply mismatch in the reserve currency issuances as well. And if you look at this chart, the blue dot or the blue line is the G4 central banks, which is Fed, ECB, BOE, BOJ. Their, QT or the balance sheet changes that they have done, and the blue line is the issuances by their sovereigns. In last 2 years, roughly 3.5 trillion annually these sovereigns have issued, and central banks have cut their balance sheet by 2 trillion each year. In some sense, $5 trillion annually has been forced upon private sector to be absorbed, and this is where is very unique again in this cycle, where rates are not coming down despite balance sheets, uh, despite Fed rate cuts. And that is where I feel that if you look at the cycle at chart that I mentioned, that earnings have decisively in FY25 come down per se. But rates, they are acting as a much bigger lag than what they typically act because of this very unique characteristics of demand supply mismatch. And to know whether market has corrected enough or rates have fallen enough, I feel one of the best indicators that one should look at is what we call as earnings yield minus bond yield. I mean, I'll just show you this chart. This is again one of my favorite charts of the presentation. The blue line is BSE 500 earnings yield. Earnings yield is inverse of P minus average of bond yields, average of 10-year US India, 10-year US bond yield and 10-year India bond yield. 10-year US and India we have taken because US bond yield captures an FI perspective, and India 10-year captures a domestic cost of equity perspective. In the sense, it's an opportunity cost of putting money into FD versus buying money into equities. Now, what you can see beautifully is that this has very high predictive power for next 12-month returns, which is that if earnings yield minus bond yields have fallen very sharply, for example, over here, equities are very cheap because markets are corrected very sharply and rate cuts also were very quick, which in turn led to earnings yield minus bond yields being very attractive. Then your next 12-month returns from that point become very strong. Now, there are disconnects in this. There are two big disconnects. This is a phase from 2010 to 2013 where equity valuations were very cheap compared to rates, but yet next 12-month returns were not very great because this was a phase where earnings growth was very weak, unusually weak. And similarly, this is a phase where if you had looked at this indicator, you would turn cautious, but yet your next 12 month returns were very good. And the reason why they were good was because earnings from nowhere rebounded very strongly because of margin tailwinds of sorts per se. But if today earnings tailwinds are not there, then to know the inflection point, you've got to look at this metric of sorts per se. So to capture the cycle best, whether equity markets have moved or adjusted to new equilibrium or not, is you have to go look at this chart. Is basically this data point. This will tell you whether rates have caught down to valuations and earnings or not. And that's where currently it feels that even after the correction, perhaps a lot more pain is likely per se. So that's it from my side, team. I mean, I'll stop here and happy to take questions per se, Shailesh, if any.
Yes, sir. Janam, why don't you send across the questions on chat? I'll screen it through because I don't want any of the questions to be repetitive. All right, so the next question, which was asked by Janam himself, when do we see demand improving across sectors? Private sector
Yeah.
capex has been talked since couple of years, but not really happening.
Yeah. So that's a great question, Janam. Now, if you look at India's all demand cycles, right, and I'll focus on that part a lot, all of them have happened through exports. India's demand cannot revive without a global recovery. I'll tell you why. Let's say hypothetically, that globally demand remains weak and India reflates itself, that India's consumption improves, we do big infra capex, and so on and so forth. What will happen? Your current account deficit will widen because you're growing faster than the world. You'll move from 1% to 3% to let's say 5%. Now, in such a scenario, it essentially means it's an accident waiting to happen. This is exactly what we did from 2008 to 2013, where we grew far higher than the world, our balance sheet deteriorated, and next 10 years, we had no growth. So, to have a sustained growth cycle, you need exports revival. And exports as well, I think we are reaching a stage where you will get a revival. I mean, today, if you look at it globally, the debt problem is in sovereigns. Now, when you have a sovereign debt problem, the only way you can come out of it is by inflating it away. Because you cannot restructure a sovereign debt. You cannot say US bondholders, you take a haircut. I mean, US bond is the most sacred instrument, in the last 50 years. If that takes a haircut, it's a serious problem. So clearly, we are reaching a stage where we will come get a solution to it. When we get a stage where US decides that they need to inflate their debt away and pursue negative real rates, that is where global demand and global growth will get lifted, and India too will see an improvement in demand both on the exports, and if we pursue the right policies, even domestic demand will move its way up. But until we get that through, it is very difficult for demand to improve sustainably across the board per se, Janam.
Thank you, sir. Sir, on the earnings chart, I had a question. If you can please
Yeah. Which one?
the bond yields and
Earnings yield.
equity yields
Yeah,
differences.
yeah, 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 yeah.
So, while we have actually, during the horizon of 2011 to let's say 2017, gold didn't
Mm-hmm.
really give much of return. So we can understand the
Mm-hmm.
differences playing out for equity or debt, either way, seesaw pattern.
Right.
But recently, with gold giving actually quite a lot of returns, do you think those dynamics have started impacting the post 2020 figures when it comes to the seesaw between the bond yields as well as the earnings yield?
Yes, that has played a role that that you're having another asset class as well, which is giving returns. But I think the bigger factor that is playing through Shailesh is the earnings dynamics itself. I mean, like for example, 2023 or FY24 is probably the most unique year in India's history, where despite earnings, despite demand weakness, earnings bounced.
Hmm.
And that's where you had high valuations becoming even higher despite very high rates. I mean, fundamentally, for equities, you either need low rates or you need high valuation or high earnings So, for example, 20 pre-COVID was an era characterized by low rates,
Hmm.
where everybody was pursuing QE, even RBI cut rates, they did liquidity injections, so on and so forth. So that was the driving force of equities. Post-COVID, at least Indian equities, the driving force has been earnings growth because earnings has bounced back, and even after Fed rate hikes, earnings growth did not get dented.
Hmm.
So that is where the disconnect has happened. So tomorrow, if gold goes up, but let's say even rates come down, then equities also can do very well. So for example, 2000s, '03 to '08, it was an era where equity, gold, real estate, all asset classes did very well because you had rates being low artificially by China. China was purchasing US treasuries, and as a result, US 10-year went nowhere. I mean, if you recall, there's a famous Greenspan's bond market conundrum where he says, I am raising rates, but market rates are not going up because China is buying treasuries and keeping rates artificially low.
Hmm.
So, in some sense, if I think we could be entering that regime, although a chaos may first precede it. But as and when that comes through, that is where I feel, equities, gold, everything will do very well.
Got it, sir. So I recall reading somewhere some time back, I think a year back maybe, the inverted bond yield structures have,
Yeah,
there was a fear of recession. How does that
yeah,
factor into this bond yields still saying up despite the rate cuts?
yeah. So see, I think this is again been very unique part of this cycle where yield curve have had a very good track record of predicting recessions, but this time they've gone wrong. And one of the reasons why they've gone wrong in last 2 years is that in last 2 years, fiscal deficit, especially in US, despite very strong economy, has expanded. I mean, a data point worth noting is that in last 2 years, US government accounted for 25% of job additions versus the average run rate of 5 to 6%. So it is because of this factor that despite yield curve being inverted, recession has not played out. And but the counterpart of it is because government gave a stimulus, that long end of the bond yields are not coming down as well.
Hmm.
So next 12 months you could have a situation where government owing to dodge scales back on their spending, which in turn leads to recession and eventually brings bond yields lower. Because in that scenario, Fed will pursue leave QT and in fact pursue QE itself per se, Sailesh.
Got it, sir. Thank you so much, sir. Kunal, you want to ask your question? Kunal, you there? I think we lost Kunal. So there's a question from Jayesh. How would improving AI capabilities affect the new hirings by IT service giants and hence domestic consumption? A little off track, but I thought probably
Yeah,
we'd take that up
yeah.
as well while the diversity at it.
Yeah, see, that's again a very good question. See, right now it's in the zone of speculation. I mean, right
Mm,
now we don't know where AI will be, how it will hit us, and so on and so forth. Here, I'll just say that the impact is from near term and from medium term. Near term, if AI does scale up and there is a lot of promise honestly being shown there, then yes, I mean, a lot of jobs or white collar jobs in India, which have been the mainstay for growth, employment, and consumption, I think can be compromised. I mean, there is no two ways about it that AI is a little different from computers. Computer wasn't was about enhancing skills. AI is doing the job of learning itself, which is, for example, in computer, every time you have to calculate, let's say 2 plus 2 in Excel, you have to punch in the number 2, punch in the number 2, then manually write 2 plus 2, it'll tell you 4. In AI, if you teach it once that 2 plus 2 is 4, and then ask the question next time, what is 2 plus 2, it'll automatically throw up an answer, which is that it is a learning kind of a thing rather than a skill kind of a thing. So from that perspective, yes, I mean there are a higher chance of disruption risk, so on and so forth. So clearly, from a near-term perspective, it does pose a problem. But from a medium-term perspective, what will happen is that AI will throw up so much productivity gains that eventually governments will fix it by channeling resources elsewhere and providing jobs, which can be infrastructure and so on and so forth. and that will have spillover to India as well in the form of exports. Only thing is that the skill set required to pursue exports or real economy stuff was a skill set that AI is going to take away, is going to be very different. So in some sense, the aggregate demand may not move materially from a medium term perspective, or may in fact be positive, but within the aggregate demand, the distribution can be different. Last 15 years, with whatever aggregate demand, the distribution has been more skewed towards white collar jobs. Finance, IT, tech has been the mainstay everywhere. But next 10 years, there's a chance that because government, focus on redistribution and Main Street compared to Wall Street, as Scott Bessent has been saying, then the spillover, and especially with AI, then you could have a demand shift going away from white collar jobs towards more of a blue collar jobs or the shop workers, which are less affected by AI and which potentially could gain from the overall economic productivity gains per se, Jayesh.
Got it, sir. Thank you so much, sir. Sir, a follow-up question on that, a little again off track, but have you used or do you currently use any AI tools to keep track of things? If you can give few examples or scenarios which our students can learn from or maybe capitalize on that.
So honestly, no, yaar. I don't use so much AI or technology, but a lot of clients do tell me that they are using AI more regularly. For example, like you get a complaint on the legal front of it. So then a fund manager told me that you ask AI to summarize what SEBI's document or whatever that thing is and file an answer. It does a good job. Similarly, for example, if you want to compare, do a channel check and compare on vegetable prices on three different portals of, let's say, Zepto, Blinkit, and Instamart, and you ask AI to upload bills and ask AI to summarize it, it does very well. So there are these aspects where it will do, and there definitely will come a point where even financial modeling and a lot of research, at least back data finding, can be done by AI. But at least I'm not using much, honestly, right now, Shailesh, that I can throw light upon, which can help students per se.
Got it, sir. Uh, Thank you, sir. Sir, on the EM index data points which you actually showed in comparison to India,
Yeah.
while the other EM countries for quite some time post-COVID saw currency appreciation, while RBI kept on ensuring that our currency remains either stable or depreciating for
Mm.
the current balance, current budget and balance of
Payments.
trade basically. To the data points which we saw, are they neutral for the currencies or that has no
Yeah,
impact?
yeah, they are neutral for the currency.
Okay, I just thought of curiosity. I thought probably
Yeah, yeah.
otherwise there might be some bit of outliers which we are trying to see into the data.
No, no, no. They are neutral currency adjusted per se.
Okay, sir. Okay, sir. Great, sir. I think, sir, we've uh, yeah, all of these are currency neutral data points, right?
Yeah, yeah. All are currency neutral.
The MSCI World Indexes, they do neutralize currency data points, is
Yeah,
it?
yeah, yeah. Yeah, yeah. They get two indexes. One you get in dollar terms, and one you get in currency adjusted terms as well.
Okay, sir. Got it, sir. Fair enough. Sir, I think we have no further questions on this. Thank you so much for taking our time. There's quite a lot of content here. We'll be sharing the PPT with the students to go through, and in case, and I'm pretty sure I will have to watch the recording again. There was quite a lot of dense talk at the start, which perhaps, I would like to pick your brains on, and we would love to get in touch with you again in case if you have any further follow-up questions on this, sir.
Sure, sure, Shailesh. It was a pleasure. Really, uh, we were really enjoyed, discussing, and very good set of questions. And wish everybody all the very best for their careers.
Thank you so much, Prateek sir. And sir, we would love to again touch base with you for another set of learning in some bit of obviously gap and pick your brains again on how you go about taking a look at different sectors, more specifically on sectors. Obviously, we've learned quite a lot today in terms of cycles, but would like to delve a bit deeper in terms of sector specific things which you may have, we would love to learn from you, sir.
Sure, Shailesh. Look forward to it.
Right, sir. Thank you so much, sir. Thank you for your time. Thank you, everybody, for being a lovely audience and interacting with sir.
Yeah. Thank you. Thank you, everyone.
Thank you,
Yeah.
guys.
Yeah.